Welcome to the Deep Dive. This is where we unpack your sources, articles, research, notes, you name it, and really pull out the key insights. Think of it as your shortcut to getting up to speed.
Exactly. And today we're digging into the Intuit third quarter fiscal year 2025 earnings call. We've gone through the transcript, looked at what management said, and we're here to break it all down.
Yeah, what actually happened, how they're framing it, and what it all might mean.
Right. We're trying to get beyond just the numbers and look at the strategy, the innovation bits, maybe even what surprised them.
Okay, let's get right into it then, because Intuit's Q3 results, they were pretty exceptional, weren't they?
Oh, definitely. The headline figures really tell that story. Total revenue for Q3 hit $7.8 billion.
Yeah, and that's up.
Up 15% year over year. Solid growth.
And you saw that flow through to the profit lines too, right?
Absolutely. GAAP operating income, that's the standard accounting measure, reached $3.7 billion. That's a 20% jump.
Okay. And non-GAAP?
Non-GAAP operating income, which, adjusts for certain items, was $4.3 billion, still up a strong 17%.
Right. So both GAAP and non-GAAP showing really healthy growth there.
Exactly. And it translates down to the bottom line, the earnings per share.
Right. EPS, what were those numbers?
GAAP diluted EPS was $10.02, up 19%. And non-GAAP diluted EPS came in at $11.65, which is up 18%.
So strong performance, especially you'd think around tax season, right? Which obviously gave them confidence.
That's the key takeaway. That performance was strong enough for them to raise their guidance for the whole fiscal year, like across the board.
Okay, yeah, let's talk about that full year outlook, because that Q3 strength wasn't just a blip, it seems.
Not at all. They bumped up the total revenue growth guidance for fiscal 2025 to 15%.
And that was up from what range before?
Previously, it was a 12% to 13%, so a decent step up.
And operating income guidance, those jumps looked even bigger.
They were. GAAP operating income growth is now forecast at 35%. That's way up from the prior 28% to 30%.
Wow. What does that mean for margins?
Well, that implies like 390 basis points of GAAP margin expansion. So almost a 4 percentage point improvement.
Mm-hmm. Okay, that's significant. And non-GAAP?
Non-GAAP operating income growth guided to 18%, up from 14%. So that implies about 100 basis points or, 1 percentage point of non-GAAP margin expansion. Still good expansion there too.
And earnings per share followed that trend.
Yep. GAAP diluted EPS growth now expected at 26% to 27%, up from 18-20%.
And non-GAAP?
18% to 19% growth, raised from 13-14%. So profits per share are really expected to outpace that revenue growth.
And they gave a peek at Q4 as well.
They did. For Q4, they're looking at revenue growth of 17% to 18%.
EPS for the quarter?
GAAP EPS between 84 cents and 89 cents, and non-GAAP between $2.63 and $2.68. So that's a pretty strong trajectory into next year.
Okay, so how did they pull this off? Let's break down the segments. Starting with the consumer group TurboTax, mainly.
Yeah, that's mostly TurboTax in the U.S. tax season. In Q3, their big tax quarter, consumer revenue hit $4 billion, growing 11%.
And the full year expectation there?
They raised that too. Now it's expecting about 10% growth for FY25, up from 7-8% previously. It really boils down to an outstanding tax season.
And the big driver within that was TurboTax Live, right? The assisted offering.
Absolutely. That was the star. They expect customer growth for Live to hit 24% this fiscal year.
24% customer growth.
Yeah, and that translates into a massive 47% revenue growth for Lev.
Yeah.
Way above their long-term goals and a huge acceleration from last year.
47% revenue growth. Wow.
And within Live, the full service piece where you basically hand it all over, that's growing even faster.
Interesting. What about the traditional DIY side? Do it yourself.
It's a bit more complicated there. They do expect total paying online users to grow about 6%, mainly because they're gaining share with filers who have higher ARPR, that's average revenue per return.
Okay, higher value filers. But overall units?
Overall online TurboTax units are expected to be down slightly, maybe 1%. And their total share of returns filed is expected to dip about 1 point as well.
So fewer filers overall, but they're focusing on the ones who spend more. Sounds like a strategy.
It is. Management was pretty clear about it. They're optimizing marketing spend, shifting focus away from attracting the lowest ARPR customers.
Oh, okay.
Towards folks more likely to upgrade to Live or maybe have more complex returns. They kind of expected to lose some share at the low end, and that's what happened.
So quality over quantity in the sense.
Basically, yeah. Optimizing for value per customer. And you see that reflected in the monetization. They expect a 13% increase in that average revenue per return for the year.
And what's driving that ARPR increase?
It's those customers choosing the higher-priced assisted options like Live, and also people taking advantage of faster refund access through the integrated services.
Right, the Credit Karma integration. How big a factor was that this year?
It's becoming a bigger deal. They think Credit Karma integration will drive about 1 percentage point of consumer group revenue growth this year.
Just from the TurboTax tie-in.
Yeah. And get this, they had a zero-click login available for about 70% of eligible Credit Karma members. Last year was only 5%.
70%, that's huge.
Right. And it drove new customers to TurboTax. Critically, 22% of those new customers actually chose a live offering.
So higher value customers coming through that channel.
Exactly. Plus, the integration helped people get faster access to refunds over $12 billion worth. So that connection is really starting to bear fruit.
What about the free filers, the pay nothing group?
They're expecting about 8 million this year. That's actually down from over 10 million last year.
Again, tied to that marketing optimization.
Directly tied. Yeah, they're focusing acquisition where they're more likely to see monetization down the line.
Okay. Let's switch over to the pro tax group, the pros.
Serving tax professionals. Revenue there grew 9% in Q3. For the full year, the expectation is 3% to 4% growth. It's a smaller, more stable piece for them.
Got it. Now, the Global Business Solutions Group, GBSG, that's QuickBooks, MailChimp, the small and mid-sized business stuff, that seemed really strong.
It was very strong. GBSG revenue was up 19% in Q3. And for the full year, they're guiding to 16% growth, which is right at the top end of their previous range.
And within GBSG, the online ecosystem is the main engine.
Definitely the core growth driver. Online ecosystem revenue grew 20% in Q3. Actually, it was 24% if you pull out MailChimp.
Okay, we'll get to MailChimp.
Yeah.
But 24% online growth is impressive.
Yeah. And for the full year, they expect that online ecosystem to grow around 20%, maybe even accelerating slightly to 21% in Q4.
Where's that online growth coming from specifically?
It's pretty broad, but some areas are hotter than others. Their mid-market segment, think businesses using QuickBooks Online Advanced or Intuit Enterprise Suite, kind of 2.5 million to 100 million in the revenue range. That part of the online ecosystem grew revenue roughly 40% in Q3.
40%, wow.
Yeah, huge growth there. And then their core small business space and the rest grew a very strong 17% online in Q3. So growth everywhere, but really accelerating mid-market.
Okay. And within that, online accounting specifically.
Online accounting revenue grew 21% in Q3. That's driven by, a mix of things. Higher effective prices, more customers, and customers shifting up to higher tier products. It boosts their ARPC, average revenue per customer.
Right. And then online services, payments, payroll, that stuff.
Online services revenue grew 18% overall in Q3. But again, if you exclude MailChimp, it was up 29%.
So MailChimp is definitely pulling that average down.
It is. The growth in services is really coming from their money offerings. Payments, capital, bill pay, and also payroll. Payments revenue grew because of more customers, higher payment volume per customer, and higher prices. Total online payment volume was up 18%, or 20% if you adjust for the leap day last year.
Okay, let's tackle MailChimp then. Still a bit of a drag.
Yeah, it is. Revenue was basically flat compared to last year in Q3. They admitted it's taking longer than they thought for the integration and innovation stuff to really move the needle at scale. And that slower growth path for MailChimp compared to what they expected at the start of the year, it's actually creating more than a point of headwind for the overall GBSG guidance.
So it's materially impacting the segment's outlook.
Correct. They say they're making progress integrating it, especially for mid-market customers using IEs, but yeah, it'll take more time.
What about the desktop business? Still hanging in there.
Desktop ecosystem revenue actually grew 18% in Q3. And QuickBooks Desktop Enterprise grew in the high 20s.
High 20s for desktop enterprise. That's strong.
It is for the quarter. But for the full year, they only expect mid-single-digit growth for desktop overall.
Why the difference?
It reflects the transition to the recurring subscription model for desktop they finished early last fiscal year. Q3 probably saw a big chunk of annual renewals hit.
Gotcha. Okay, finally, Credit Karma. This segment had maybe the most dramatic guidance change.
Oh, by far. Credit Karma revenue shot up 31% in Q3. Really strong performance in credit cards, personal loans, auto insurance.
And the full year outlook now.
It's incredible. They're guiding to 28% growth for Credit Karma for fiscal 2025.
28%. What was the old guidance?
It was just 5% to 8%. So massive, massive increase.
Okay, what's driving that kind of acceleration? Is it just the market getting better?
Well, they acknowledged continued stability in the macro environment helps, but they really stressed it was their own execution. They kept using the term management alpha.
Management alpha, meaning?
Meaning they think they're generating performance above what the market conditions alone would dictate. It's down to things like AI integration, helping match offers better, which drives higher revenue per customer, and specific product innovations, like something called Lightbox, helping them take share in credit cards and loans. Plus, they're gaining traction in insurance, too.
So they believe they're actively outperforming, not just riding a wave.
That's the message. Using their tech and product smarts to create more value and monetizing it better.
Which tees up their broader innovation strategy nicely. AI is clearly central.
It's the foundation. This AI-driven expert platform idea. They talk about a virtual team, AI agents, working with AI-enabled human experts. The goal is to help their, nearly 100 million customers?
Yeah. Automate tasks, manage workflows, maybe even solve problems before they happen.
Exactly. Using predictive insights. We saw a lot of that play out in tax this year.
Right. How specifically?
Well, they use data and AI for the whole customer experience. These done-for-you experiences, using AI to pre-fill data, reduce the average time people spend on returns by 12%.
12% faster.
Yeah. And they integrated data from way more partners, over 200, covering 90% of common tax documents now, up from 68%. AI helped guide people to the right, offering DIY, live assist, or full service.
And it helped the human experts, too.
Big time. Reduced their prep time by about 20%, so they could spend more time actually talking to customers. And that apparently led to double-digit improvement in converting people to full service.
And they're doing similar things on the business side, QuickBooks, etc.
Same playbook. Done-for-you experiences, AI power, human experts for the tricky bits. They mentioned almost a quarter of invoicing customers use these new AI-generated reminders.
Where do they work?
Apparently saw over 10% higher payment conversion on overdue invoices. And they saw QuickBooks Live connections to experts double.
They also talked about a next chapter of innovation. Sounds big.
It does. Launching a broader set of AI agents, specific ones for customers, payments, finance, projects, accounting.
And the key is they talk to each other.
That's the vision. These agents communicate to handle entire jobs seamlessly. The goal is predictive insights, smart actions taken for the user, connection to experts when needed, but the customer's always in control.
And specific agents for mid-market, too.
Yep, definitely calling that out. It ties into that huge mid-market push.
Yeah, that focus seems really core now. What's the market size there?
They estimate it's an $89 billion total addressable market, TAM, focusing on businesses doing roughly $2.5 million to $100 million a year, using QDO Advanced, IES, the whole ecosystem.
And the pitch is basically, ditch your other apps, use us.
Pretty much.
Yeah.
They think mid-market companies use too many disconnected, expensive tools. Intuit wants to be the one-stop shop for performance, visibility, insights, operations. They told this story about an 18-entity title company.
Oh, yeah, I saw that. They left a competitor's ERP.
Yeah, left an ERP and came back to Intuit Enterprise Suite after just 2 months.
Wow. Why come back so quickly?
According to Intuit, the company cited the IES value prop, seamless integration with their other apps, the multi-entity features which were crucial for them, consolidated reporting, and the overall value, including MailChimp being integrated.
So it suggests IES is really becoming competitive now, feature-wise.
That's the implication, that it's reached a maturity level where it's a compelling alternative, even for complex businesses that might have previously thought they needed a traditional ERP. It's a big proof point for them.
Definitely adds weight to that mid-market strategy.
For sure. And they're pushing innovation hard on IE's quarterly releases. The March one added multi-entity expense allocation, a monitoring hub, better forecasting tools. They're also working closely with big accounting firms.
Are those firms just sales channels?
No, they were clear. They see them as critical partners. Those firms have driven about 15% of IE's deals so far. They're still learning the go-to-market motion there, but the opportunity is huge.
Okay, let's pivot to financial management. Balance sheet, capital returns.
End of the quarter pretty strong. Got $6.2 billion in cash and investments, $6.4 billion in debt.
And capital return, buybacks.
Yeah, they bought back $754 million of stock in Q3. They have this plan to basically offset the dilution from stock compensation over 3 years.
Right, offsetting shares issued to employees. Dividend.
Board approved a quarterly dividend of $1.40 per share. That's up 16% year over year.
Nice bump. And they mentioned AI helping internally too, right? Not just customer facing.
Oh yeah, big time. They're using it across the company for efficiency. Customer success, tech developers coding up to 40% faster, they said finance, marketing, sales.
40% faster coding.
That's what they claimed. They see it as early days, but really promising. Gives them confidence they can scale the business, keep investing in growth, but still have operating income grow faster than revenue. Keep expanding margins.
And maybe hire less aggressively in the future.
Exactly. They expected to reduce the rate of headcount scaling compared to what they'd need without these AI efficiencies.
So, AI for customer value and internal productivity. Dual benefit.
That's the play.
Okay, stepping back, the investor context. Macro environment still uncertain. How are they framing their resilience?
They acknowledge the uncertainty, sure, but they lean heavily on the mission-critical nature of what they do. Businesses and people have to manage money, pay taxes, handle cash flow, no matter what.
Right, it's not really optional.
Exactly. And they feel their broad platform, diverse customer base, and all the data insights give them an edge in navigating it. Plus, over 90% of revenue is recurring or subscription. That helps a lot with predictability.
And they call themselves a low-cost disruptor. In what sense?
In areas like assisted tax and mid-market, they argue their integrated platform saves customers money compared to using multiple separate, maybe pricier apps. That value prop drives ARPC.
Makes sense. What about the longer-term vision? Where's the growth coming from?
Still confident in double-digit revenue growth with operating income growing faster. They see a huge $300 billion total addressable market to go after.
And the focus is?
Really accelerating in small and mid-market businesses.
Yeah.
That's about $180 billion of the TAM, they figure, with roughly half being that mid-market segment they're really targeting now.
And they restructured leadership to push that.
Yeah, they announced new leaders for small business, mid-market, and services within GBSG, all reporting directly to the CEO, signaling they want more focus, more speed in those critical areas.
Okay, let's switch gears. It's time for our segment. This is not financial advice, where we pitch a totally speculative, maybe outrageous, but kind of plausible trade idea based only on the story we just heard.
Just for fun, just based on the narrative from the call. Absolutely not investment advice. Please don't trade based on this.
Okay, idea number one, the boomerang bet.
All right, what's the boomerang?
The idea is you go long into it, not just for the usual reasons, but specifically betting they can win back mid-market customers who left for competitors, like traditional ERPs. That 18-entity title company story, that's the core of this bet. It's presented as proof they can do it. Okay. So the bet is that IES is now good enough, or even better value, to pull customers back from the likes of NetSuite or others. It's not just about holding their base, but actively poaching or reclaiming lost ground in that bigger mid-market space.
Exactly. You're betting the market hasn't fully priced in this potential boomerang effect, this ability to really compete and win back share in that huge $89 billion mid-market TAM based on stories like that one. It's about hunting outside their usual territory.
Interesting. Okay. Plausible narrative. Idea number two.
Idea number two, the agent ARPU explosion.
ARPU explosion from AI agents.
Yeah. Go long into it betting that those new interconnected AI agents they talked about will drive significant average revenue per user expansion, maybe through new pricing models.
How so? What kind of pricing models?
Well, they hinted it might go beyond just flat subscriptions, maybe consumption-based pricing for specific AI agent tasks. Or charging more because these agents automate workflows that previously required other software or even human effort. Right, so the pitch is, these AI agents create so much value, automating complex stuff, replacing other apps, that Intuit can capture way more of that value per customer than current models assume. The done-for-you capability is worth a lot more.
Exactly. The bet is that the market is underestimating how much Intuit can monetize this AI transformation, leading to surprise upside in ARPU growth. Maybe MailChimp even finally starts adding to ARPU growth as it gets woven into these automated workflows.
Okay, another narrative-driven bet focused on monetization potential for the new AI strategy. Got it.
All right, so wrapping up, Intuit clearly had a very strong Q3 FY25, strong enough to significantly boost their outlook for the whole year.
Yeah, the performance seems really driven by solid execution, especially in tax with TurboTax Live, and that continued momentum in the business platform, powered by their AI strategy and that growing mid-market focus.
Management certainly sounds confident about hitting double-digit growth and expanding margins long-term. They see a huge market opportunity ahead, and AI is key to both customer value and their own efficiency.
Definitely. So maybe the question to you, the listener, is what does this Intuit story, this focus on integrated AI platforms disrupting existing markets, tell you about the broader tech and business software landscape going forward? Something to think about.
And just to reiterate, Everything we discussed today is based on our interpretation of the company's earnings call, and it's purely for informational purposes. It is definitely not financial advice.